Hi there, my name is Miles Pitcher. I'm the owner of Superior Lending. Thanks for checking out my videos. I may not be the most exciting presenter, but I do believe that we have some of the best content and advice and help with mortgages and your financial decisions. So today we're going to be looking at a question that frequently is considered, asked, or should be asked more often is, how much of your income should actually go to your monthly payment? And what's a good way to evaluate that? Let's jump into it. All right. So there's two things that I look at. Number one, I always ask the client, what are you comfortable with on a monthly payment? Have you prepared a budget? What's the maximum amount that you could make in that monthly payment without feeling like you're house poor? I don't ever want a client moving in a house feeling like they are just strapped living in the poorhouse. I want them to feel good about that monthly payment, even though it may stretch them slightly, which is kind of where we're at right now in today's market. But that comfort level, that number may be different than what the maximum qualifying amount is. So we're going to look at both sides of that. Sometimes pushing that max to the max qualifying amount, there's factors that come into it, such as, do you have a bunch of other debts, right? Are you debt free? Does your job or your new self-employment, is there potential for growth there and future income growth? Are you in a spot where maybe your wife is going to stop working as you start having kids, and so you're going to have a reduction in income? That should be factored in. Have you saved up in an emergency fund? Are you prepared to handle a recession where maybe you lose your job and you have several months where you're not going to be able to have an income coming in? Those are factors to be considered. If things are in a really good spot, you have a solid job, then maybe we stretch to the max qualifying amount. But we're going to look at that. The thing that we look at is called a housing debt ratio, often abbreviated as DTI. And we call this the front-end ratio, meaning we're taking your gross monthly income, let's say that's $10,000, just for example purposes, and then we divide that by your mortgage payment. Let's say it's $2,500 a month. Included in that monthly payment needs to be principal, interest, taxes, insurance. When I say taxes, I mean property taxes. Insurance is homeowners insurance, HOA fees, if applicable, and mortgage insurance or private mortgage insurance, if applicable. We put those all together, we do the division, and if it was 2,500 and your income was 10,000, that's a 25% front end or housing debt ratio. Okay, we'll use that in our evaluation today. Our good friend Dave Ramsey, who I like a lot of things he says, and I have a good friend who jokes and says that you'll never go broke following Dave Ramsey's program, but you'll never get rich following his program. And I agree with that. But he says that you should not be looking at your gross monthly income. You should be looking at your take-home number, and your mortgage should be no more than 25% of your take-home income. He also says that you should have an emergency fund 3 to 6 months. I agree with that. And he says you should be completely debt-free. I don't completely agree with that. And then he says you should have a down payment of 20%. He's revised that recently to be 10% for first-time home buyers. I think you should get in a home when you can get in a home and you can afford the payment. But we'll look at numbers. So let's take a scenario. 80,000 salary, maybe that's one person, that maybe that's a couple together. And then we're just going to assume that you're going to be paying withholdings or payroll taxes of around 30%. Okay. So let's make this bigger. Here's our Dave Ramsey situation. So 80,000, that comes to gross monthly of 6,600. If we take out 30% for taxes, you're looking about 4,600. according to Dave Ramsey, your monthly payment with everything included shouldn't be more than $1,167. You're not going to get much of a house with that payment. Let's look at the max qualifying under FHA and conventional, my two favorite programs. Well, two of my favorite. I have other ones too. But you can see that on FHA, our max qualifying is going to be put us around 3127, and conventional is even a little bit higher, 3267, or 49% front end housing ratio. There's two more programs to look at, and these are my zero down programs. One is USDA and one's VA. USDA is very restrictive on this housing ratio. They're going to be 29% up to like 31%, depending on the scenario. I put in 29 to be on the conservative side, and you can see you don't get very much there. VA has a caveat here in that, boy, you can stretch VA. The highest I've ever done is a 61% front-end debt ratio. The client had great credit. They had extra money in savings or reserves, and we were able to stretch them all the way to 61%. So just be aware that there's a lot of flexibility in VA. We love it, but you have to be wise about not getting a payment that's going to make you feel house poor, okay? So how much home does this get you? Let's take a look here. The Ramsey scenario, we're going to assume our client has great credit. They have the 10% down payment. We're making a guess on property taxes, homeowners insurance, and mortgage insurance. If interest rates are around 7%, we reverse engineer that 1167, and you can buy a home for $152,000 and get a payment right around 1167. If rates drop to 6%, you could get a $174,000 home. 5% rate, $193,000. Okay. Let's take a look at my FHA and conventional. You can see with the same credit score, and the down payments will vary, right? FHA is 3.5%. Conventional, the sweet spot's at 5% down, but you can see the difference in those monthly payments. 6% FHA, you can get to $482, $510 with at a 6% interest rate, 5% down conventional. Here's my USDA and VA. USDA doesn't get very high. USDA is a great loan. They have great rates. They have super low mortgage insurance on them, but those debt ratios are just so restrictive. And then VA is just on the other end of the spectrum that is wide open, and you can get up to some really large amounts in there. Okay. You may need to pause and look at this chart, but I hope this helps you look at this and consider. I personally like having around 30% to 35% of your gross monthly income going to your monthly payment. And that should be a good, comfortable spot. Again, there's other factors, right? Do you have savings? Do you have reserves? Are you out of other debt? Does the prospect in the future look good for your job? If that's the case, then yeah, let's stretch your debt ratios. Also, do you believe that you're going to be able to refinance in the next time period? Or maybe you have a seller of the home that you're buying that will help you buy down the interest rate. Those are other factors to consider. Here's how you can get a hold of me. Always happy to help. Always happy to run scenarios for you and discuss this. Thanks for watching the video. Have a great day.